Okay, hi everyone. This is going to be the first lecture for chapter 2. So, what we're looking at here is things like the IRS, compliance, filing dates, audits. This is an appropriate picture, right? If you've ever seen the movie Happy Gilmore, what happens is the grandma gets audited, they take her house, and then Happy Gilmore has to become a golf player to try to win the money to pay off the IRS. So, in this chapter, right, we're going to be looking at things like filing requirements, the statute of limitations, the audit process, if you go to court, the different courts involved, tax law, tax research, ethical standards, and then practitioner and taxpayer penalties. Okay, so as a starting point, right, we need to distinguish the tax year from the calendar year. In this book, we're using bases everything off of the 2023 tax year. So the idea with that is the tax year is the year in which you measure your income and expenses. A calendar year, however, is separate. And what we mean by that is, let's say it's February, right, of 2024, you're doing your tax return because you know it's due April 15th. When you're doing the tax return in February 2024, that is for the 2023 tax year, right? You may be in the 2024 calendar year, but you're doing the prior year's tax return. So a lot of times people think it's 2024, I'm doing my tax return, this is my 2024 tax return. No, you do your 2023 return in 2024. All right, so who must file? Well, corporations, generally all of them, regardless of their income. Estates and trusts, right? If you have more than 600 bucks of gross income. Individuals, generally, if your income is below the standard deduction, you do not have to file. Now, we'll talk later on about the standard deduction, but for right now, let's just say it's roughly $14,000. So the idea with this is the deductions reduce your taxable income. Let's say you made 10 grand, right? If you made 10 grand during the year and there is a $14,000 standard deduction, that in essence will take you down to $0. You don't owe any tax. So, hey, I make 10 grand, I don't got to file my tax return because the standard deduction is going to wipe me down to zero. However, right, you're still going to want to file. The reason being is you want to get those taxes that were withheld from your paycheck during the year, you want to get those back, right? So that's the idea of must file versus should file. You make 10 grand. No, you're not required to file. You do not have to file. However, you still should file to get your refund back, right? To get your money back that was withheld. All right, so when must you file? In other words, what is the due date by which you must file? Well, for individuals, the standard is going to be the 15th day of the fourth month after the tax year end. So for most individuals who are going to have a 12/31 tax year end, the filing deadline is going to be April 15th. January, February, March, April, right? You can count on your hand, add 15 days, 4/15. Right? However, there are situations where there can be an alternative tax year end. Maybe there's a business reason or a purpose where you could have a different tax year end. So by way of example, if it was a 5/30 tax year end, then you would have to do 4 months and 15 days. So 6, 7, 8, 9, add 15 days, 9/15. So you can remember it, April 15th, but the more exact standard, and you need to be aware of it for the exam, is the 15th day of the fourth month. Now, in this framework, right, if you're calculating the 15th day of the fourth month and that happens to be and land on a Saturday, Sunday, or holiday, what you then do is you move the deadline out to the next day that is not a Saturday, Sunday, or a holiday. So simple example, 4/15, it lands on a Sunday. We will then move the filing deadline out to Monday, right, 4/16. Next thing here, right, there's also the ability to have an automatic 6-month extension to file. However, right, this is not an extension to pay your tax liability. So if we look at this guy right here, right, say it's 414, right, and you're trying to do your 2023 tax year return, and you're saying, hey, I'm missing this document. I can't do my tax return because I'm missing this document. I'm going to get my automatic 6-month extension to 10/15. That's great. Here's the deal though, right? While it extends, you can wait until then to file. You still have to pay at 414 when you do the extension. In other words, you have to look at your return, your 2023 tax year, figure out what your income and expenses are. That one document you're missing, you have to estimate what it's going to be. And then based on those estimates of your total income and your total expenses, that will figure out if you have a tax liability for the tax years. In other words, let's say here, hey, we plugged in the information in the software for that missing document. It's saying that we owe $1,000 on the tax return. We will punt it out, the actual filing, 6 months, but here we got to pay the $1,000, okay? Now say 6 months later, we do the extension. We actually file the return. We get that missing document. We put it in, we actually owe $1,500. So we send in $1,000, but we owe $1,500. The difference between those, that marginal $500, you could get hit with an interest and penalties on that. So basic framework, right? 6-month extension to file, not to pay. All right, C Corps, when's it due? 15th day of the 4th month, 6-month extension to file, not to pay. Partnerships and S Corps, 15th day of the 3rd month, 6-month extension to file, not to pay. What does this mean, right? What's the standard? What are you generally going to see? Well, if you're in busy season, right, the first kind of hurdle, the first 3 months of January through March are going to be flow-throughs, right? Your partnerships and S Corps. And then for the last month of busy season, you're going to be doing individuals and C Corps. Likewise, right, come the fall, right, you're going to have extensions, right? So 9/15, you're going to be doing extensions for partnerships and S Corps. 10/15, you're going to be doing extensions for individuals and C Corps. So when are you busy as a tax accountant? Generally in the winter, generally in the fall. All right, next thing here, the statute of limitations. This basically says, hey, you filed your return. How long after you file this return can the IRS come after you? And the general rule is going to be 3 years. However, the more specific rule and what you need to know is that it's going to be 3 years from the later of the dates when it was filed versus its original due date. So let's look at an example here to show that, right? So step 1, right, you're going to just plug the information in. What was the actual filing date? When did we actually file? Maybe it was 1/15. When was the original filing due date? 4/15, okay? What's the later of these two? Right, well, 4/15, that comes later in the year. So you circle that, carry it over, add 3 years to it. So year 5, year 2 to year 5. What does this mean? Well, if you filed your return on 1/15 year 2, the statute of limitations, the IRS can come after you until 4/15 year 5, right? So that's kind of taking and showing some numbers, mechanically applied it to that rule right there. Now, sometimes, right, the actual filing date can be the later of the two. So just be aware of that. You can look in the Excel problems. Couple other things here, right? That filing or the statute of limitations, that can extend to 6 years if you admit 25% of gross income, or it can be forever if the taxpayer committed fraud or failed to file. So general 3 years based on this specific standard. You can use this framework. However, it can be 6 years or forever. Next thing here is, all right, so we know the window within which they can come after you, the statute of limitations. What mechanisms do they have in play to evaluate whether they do want to come after you, right? Well, the idea here is they have this DIF system, they have the document perfection program. in the information matching program. The DIF system is basically where they're looking at kind of like traditional areas of taxes that people take advantage of or cheat in. It tends to be more complex deductions and calculations. They would assign a score to you. So that's kind of the rarest of the three. More likely what you'll see is this document perfection program, and most likely is information matching. Document perfection, this is just checking the math on your return. Right, they're footing, they're summing, they're making sure that everything you did was accurate from a calculation standpoint. And when you e-file, right, they can run these programs and systems that check that. Most likely what they're going to use and how they get people the most is through this information matching program. And what this means is, right, every tax document you get, the IRS gets a copy. So, hey, you get a W-2, the IRS also has a copy of that W-2. And if you did your tax return, right, and you failed to include that W-2, they would match them up. You'd say, hey, we got this, but you didn't report it. You know, you're going to owe $500 or something, right? Whatever the case is. The question then becomes, theoretically, right, why, if the IRS has all of the tax documents ostensibly, why do we even need to do our return, right? Well, the answer there is going to be that in applying the tax law to the taxpayer, the IRS, with just the tax documents, is unable to complete the return for the individual. And what I mean by that is the IRS isn't going to know, for example, if Homer has any children, right? They can't look into a crystal ball and see that you had a child during the year. Likewise, right, these are only W-2s, 1099s. What happens if somebody pays you cash, right? You would have to self-report that. Likewise, things like deductions, right? Maybe you're trying to take medical expenses. The IRS doesn't know that. I mean, the doctor isn't sending all of your bills to them. So they have enough to match things up, but they don't have enough to basically do the entire return. Okay, they now have said, we want to go after this person. We've identified these issues. Maybe, we, have found the error. We want to go and investigate this, right? We're going to conduct an audit. How do they do it? Most of the time, it's going to be a correspondence audit. And this is basically a notice, right? You get a notice sent in the mail. We have found that you've been missing. You didn't report that W-2. You owe $500, right? 9 times out of 10, it's that. The next level up, right, is an IRS office audit. And what that means is it's like the principal calling you into his office. You got to go into your local branch, your local IRS, and meet with them in person. You go to them. Finally, the last level is a field audit. They go to you. In other words, they show up at your place of business. They're looking at your books and records, your inventory, making sure it's accurate. So that's the least common of the three. All right, so let's say they do the audit. They tell you, hey, you owe $500 and you're going to protest this, right? How do you proceed after the audit? Well, essentially, there's like a 5-step or 4-step process here. They're going to give you a proposed adjustment. We think you owe $500. There's going to be a 30-day letter, a 90-day letter, and then afterwards, you go to court. So they try to mediate it between you and them up front, like, can we please resolve this ourselves? And if push comes to shove, then you go to court. Now let's look at this a little bit more specifically, right? Step 1 is they're going to provide the proposed adjustments. You owe $500. In this way, right, you can do one of two things. You could pay it, call it a day, or you could dispute it, right? I'm not paying the $500. If you dispute it, right, then what happens is you get a 30-day letter. And essentially the 30-day letter says you can now do one of 3 things. You can pay the money, right? That's pretty much always on the table, paying the money. You can do nothing, ignore it, or you can have a conference with us and try to resolve it, okay? All right, so say you either did one of the following. You ignored that 30-day letter, or you set up a conference and you couldn't resolve it, right? Now what happens is you get a 90-day letter, known as a statutory notice of deficiency. Here, you have 90 days to basically do one of two things: pay the liability or go to court. Now, what court you go to depends on like what the variables are of the case, and there's strategy involved. In other words, there's three courts you could pick from. There's the district court, the court of federal claims, and the tax court. The first variable, the first consideration is, do I want to pay the tax liability and fight to get the money back, or do I just want to straight up sue them, right? The district court and the court of federal claims, this requires that you pay the money and then you sue the government to get it back. The tax court, in distinction, you do not have to pay the liability. You just sue them, right? So that's the first variable. Do I want to pay or do I not want to pay? Second variable is, what type of judge do I want to get, right? The district court and the court of federal claims, these judges are going to be generalists, right? It would be like Judge Judy, right? Anything that walks through the door, they're going to adjudicate. In distinction, the tax court, right, the judges are experts in tax law. So if you had a very technical case, right, like you think on the merits based on the law you should win, you might want to go to the tax court because you could get an expert in tax. Finally, right, a third consideration would be, do you want a jury, right? If you have a case that's really going to tug on the heartstrings of people, you want your peers to decide, you want a jury, then you have to go to the U.S. District Court. So, and the basic idea with these is, these are all going to be the functional equivalent of a trial court. If you lose at them, you then go to an appellate court. And if you lose at the appellate court, you then go to the Supreme Court. So here's kind of a slide showing you the framework here for how we got here. Here's the court system, right? We have the district court and the court of federal claims. You got to pay and then sue to go to those. Tax court, you just sue. If you lose, right, you have the appellate courts. If you lose at the appellate courts, you go to the Supreme Court. Here's the circuit courts, right? So these are kind of like, you know, these middle guys there, like where they fall into, right? So Pennsylvania is like the Third Circuit, West Virginia is the Fourth. These are important, as we'll see, for purposes of this Golsan role later on. So with that, let's just pause here, right? Because we're kind of halfway through the deck. This will be the end of chapter 1. We'll pick it up with tax law sources.